SYGNUSgroup.com. And this is if you don't have access to the Q&A feature within the platform. So at this time, I will hand over to Jason.
Thank you, Justine. Good morning, everyone. Welcome. So today, as Justine said, we'll be going through SRF's quarterly performance as well as the 6-month performance. As is normal, the full financial information is contained on the JC website as well as on SYGNUS's website under real estate. And I also encourage everyone, when you're reading interim financial statements, that you go ahead also and read them in conjunction with the audited financial statements. Okay, so that being said, let's jump right into it. As usual, we start out with just creating some backdrop for the 6-month and quarter results. So the first thing I want to highlight here is that SRF has been, as we would have said for those who came to the annual general meeting and those who were on the last earnings call or listened to it, would have been, provided a lot of information about the fact that SRF is approaching the end of its first investment life cycle. And at the same time is also starting a new investment life cycle. And as a result of that, there are a number of changes that are taking place simultaneously within the firm, right? Because as you get to the end of your life cycle, it means that you're in a harvesting mode to get back your investment, get back cash flow, which will then reutilize in a new investment life cycle. But that also means that you'll have a slowdown in the deployment of capital because pretty much all your capital is already out the door and you're waiting to get that back. So the first item I want to go through with that kind of backdrop is that, one of the things that we would have done over the period during the last quarter, and I guess over the 6 months, is to basically move aggressively to start the process, which we are pretty close to, which we expect to complete by the time we get to the end of the financial year, which is to, basically the process to monetize and optimize the strategic mix of real estate investment assets that are on the balance sheet. Because as you'll see later when we show, as usual, the listing of the assets on SRF balance sheet, obviously it has majority investment property. We have some income generating assets span between real estate investment notes, which are actually third-party investment projects that we finance using debt and or quasi-debt instruments, as well as lease income from projects that we have developed or that we own. So we're not in the business of buying assets in order to generate lease income, but we will generate lease income from developments that we have executed, and then we keep a part of those developments. And I'll get into this a little bit later. So what I'm saying here is that we are, far advanced in trying to monetize and optimize the strategic asset mix, which for the most part is primarily weighted towards investment property at the moment. But that weighting, as we exit from the first investment life cycle and begin the second investment life cycle, that strategic mix is expected to change for the better in terms of enhancing, for example, enhancing the income that the firm generates, increasing as we get out of, for example, One Belmont joint venture, basically getting into other joint ventures, which means that ultimately we'll reduce the value of just pure investment property as on the balance sheet. And we're doing that in order to obviously optimize returns, as well as to, very important for shareholders, start paying the first dividend. So the second thing, segueing into One Belmont, since I just mentioned it, of course, would have already provided information on this, that during this quarter, just conclude the quarter, we would have achieved practical completion. One Belmont is now at 98%. We expect completion of One Belmont in very short order. All the pretty much majority of the tenants have either started or are about to start the interior build-out works. We're executing the formal lease agreements. So if you remember before, we had primarily agreements to lease by prospective tenants. So what we are doing now is executing those lease agreements, which means that the clock will start in very shortly on those contract terms, which then means that we can, when we have already started the process to structure our partial exit, because we won't exit all of One Belmont, we will obviously keep a portion that will generate this income and grow in value for the firm and for shareholders. Third thing is that, of course, book value year over year, a similar quarter, $22.91 at the end of the quarter versus $22.32 at the end of the same quarter last year. So just like I did at the AGM, where I keep harping about the fact that the book value of the firm is $22, almost $23, but the stock price of the firm in Jamaican dollars is, 50% or so below, which means that the firm, from my point of view, from our point of view, is severely undervalued. Spoke about investment life cycles, so I won't really delve too much into that again, except just to highlight the fact that to start the second investment life cycle, there are two key strategic topics that we are focused on, which we have already done a lot of work on, and that is the $5.7 billion beachfront, 14-acre beachfront Mammy Bay property in St. Ann, and of course the $2.6 billion Lake Spanish industrial, 55 acres of industrial property in St. Catherine. And I'm sure that we provide some additional information on this later in the presentation. So that's the background. Obviously, SRF is a specialized finance company. We're not a REIT. We're not investing to generate lease income. We're investing to generate gains as well as income, nice blended mix, so that we can unlock value for shareholders and increase book value and value for shareholders over time, and hopefully increase the stock price beyond the book value and start paying dividends in a consistent manner, which we expect to occur close to the end of the first investment life cycle, which we are very close to that. So you can flip to the next slide, Justine. So in terms of the performance for the 6 months, interim financial results, as I would have represented on this earnings call last quarter at the AGM and pretty much every single quarter since SRF started, that the interim financials are going to reflect lumpiness. And for the 6 months, we saw much more of that, where the firm would have generated a negative total investment income of $55.31 million. Negative net investment income of $228.1 million, and therefore a net loss of $320.13 million, relative to a net loss of $301.87 million in the similar period last year. Last year, of course, that negative profit ended up being that loss ended up being a net profit at the end of the financial year, and of course we are striving to do the same thing at the end of this financial year. With the addition that, in or around the partial exit of the last strategic asset during the first investment life cycle, we are hoping that, well, more than hoping, we are planning that we'll be in a position to provide that long for distribution that we have spoken about so much over the past 12 months. Just to also highlight that, over the past 4 years, financial years, that we would have generated almost 23% as a return on average equity. So now, as we are beginning to harvest those large strategic assets, we want to reward shareholders with some form of cash distribution. You can go to the next slide, Steve. Similar results for the quarter. We would have total investment income would have been negative 24.35 million versus 11.9 last year. Net investment income would have performed a little bit better, still a loss though, of 113.22 million versus a loss of 124 million last year. And then net profit would have been a loss of 187.15 million versus 129.37 million for the Q2 results. They can flip to the next slide. Let me just highlight a few items on the income statement. So just to provide some context again, for both the quarter and the 6 months period, you can see where interest income would have been more than offset by interest expense, resulting in negative net interest income. And as I would have explained at AGM and last quarter, the negative outcome for net interest income really reflected and continues to reflect the fact that as we get to the end of the first investment life cycle, we are bridging the exit. So right now, One Belmont final stage is going through all the things that I explained, but we are not waiting until One Belmont is exited before we start our new projects, right? So we have gone ahead and used debt to bridge that gap, start those new projects. When we exit One Belmont, then we reduce our debt and redeploy some of that capital into new investments, pay dividends, etc., and then go again. So during the interim, as we are at the back end of our investment life cycle, we are using a lot more debt, and the volume of debt that we are using relative to the volume of interest income earning assets on the balance sheet means that we have more interest expense than interest income. So interest expense also went up, but it didn't go up by much. I think it went up by about 125 to 150 basis points. So it's not the increase in the interest expense in the cost of debt per se that is really generating net interest income. Is really the volume of debt that we are using. Let us explain. We are bridging the gap to some of the major exit that we have, and once we get to that endpoint, then we reduce debt and then we go again. Lease income would have increased substantially year over year, but obviously it's not material enough to offset the negative net interest income. And what we'll see on a go-forward basis here is that we have some assets, and I spoke earlier about we have advanced the process to monetize and optimize the real estate investment assets, the asset mix on the balance sheet. So what will happen is some of the assets that are generating income, as we monetize some of these assets, that income will go away in terms of lease income on one hand, but on the other hand, as we exit, for example, a large project such as One Belmont, moving from a joint venture into a lease generating asset, then the size of the lease flows that are likely to come from, example, One Belmont will dwarf the assets that when we monetize them, the income that we're going to lose from them. So you're going to see more than likely as we go to Q3, perhaps a drop off in lease income to be followed by a big jump in lease income as we kind of rejig, as the balance sheet is rejigged a little bit with the movements in some of the assets on the balance sheet. Of course, during the quarter and the 6 month period, we would not have had any gains, whether any material movement in gain on joint ventures or loss, or gain on investment property, primarily because the revaluation of these assets actually take place at the end of the financial year, and SRF is actually in the business of generating gains from its investment in real estate. And so because we only do that exercise once per year, you don't expect to see any material movement until you get to the financial year end. Of course, if the exit of One Belmont is structured prior to the end or during an interim financial quarter, or any investment for that matter, then that's when you would see a major movement. But as is right now, there are no movements to speak of. And so that's the reason why we generate negative total investment income and negative net investment income. you can see that what we would have done during the quarter and for the 6 months is that in terms of total operating expenses, would have kept that in check. As you can see for both the quarter and the 6 month period, total operating expenses was lower at 88.9 million versus 112.2 million for the quarter, and at 172.8 million versus 215.9 million for the 6 month period. Fair value gains and net foreign exchange gains and losses, those fluctuate depending on which way the exchange rate really moves and which way interest rates really move. So, those are going to move around, jump around depending on market rates. So I just wanted to highlight those in particular just to give some color on the movement in net interest income, why it's negative and why as we go through time we expect that to change, and more so lease income, the movements, well, why the movement has gone up, but more so what you can expect as we go through third quarter and into fourth quarter, where we expect maybe a deceleration and then a substantial ramp up. Next. Briefly here, efficiency ratio, which is basically taking how much expenses we are generating per dollar of revenue. We had set a threshold limit of 3.5%, and as you can see, we are well within that threshold limit at 2.3%. And from a management expense ratio point of view, we only capture that at the end of each financial year, because if we are generating negative revenue, then there is no ratio that you can measure. Of course, we expect by the time we get to the end of the financial year to turn that around, as we have done for each of the last 4 financial years, so that we can actually measure that ratio. So what we're really looking at here is whether or not from a expense management point of view, are we managing the firm according to global best practices in terms of ensuring that we are very efficient and there isn't a leakage of earnings into expenses, which, so far we have been doing a decent job of that. Next. So now just to give some color for the activity. So over the period, 6 month period, the balance sheet in terms of real estate investment assets would have increased to almost 15 billion. That's 14.96 billion, up from 14.1 billion for the same period last year. And how that is broken down into 3 major categories. Total property investments at 11.59 billion, up from 10.67 billion last year. Real estate investment notes, 1.83 billion, down from 2.18 billion. And joint ventures, 1.54 billion, up from 1.2 billion. So I need to provide some comment here. So I spoke about on the first side that we are seeking to monetize and optimize the real estate investment asset mix, right? So what that really means is that as we do that, you can expect there to be some shift in terms of the value that is being represented by investment property, perhaps going down a bit, and then you can also expect the value in real estate investment notes going down a bit at first and then ramping up substantially. Maybe depending on when those investments take place, you may not see it at the end of a quarter results, but certainly real estate investment notes are expected to ramp up substantially as we head into the second investment life cycle. And we expect that the figure that you're seeing here would more than likely, more than double over the short, over say the next 12 months, substantially, maybe more than 2.5 times. As far as joint ventures go, obviously joint ventures here represent One Belmont, which basically we are in exit mode as we speak. So what will likely happen here is that this value will go down as the asset moves from as we move to exit. The asset moves from perhaps being represented as a joint venture and start to show up as something else, right? So But at the same time, we are also looking to ramp up substantially our deployment of capital via joint ventures by partnering with many other owners of valuable real estate across Jamaica and in the wider Caribbean region. So over time, certainly, over the next 18 or so months, this value is likely to fluctuate. Perhaps it goes down, but then it's gonna ramp back right up, right? So the way you look at the mix now, it will probably shift, where REINs will be a larger percentage of the overall assets on the balance sheet than what it is now. Joint ventures may go down as we exit one Belmont, but then it will ramp back up, and then property investments will likely be reduced as we go through time. So that will provide us with a better mix of, from assets that are generating income, such as REIT, as well as what will now become perhaps a more substantial part of the balance sheet, where we are generating lease income from an asset that we would have conceptualized and see through to execution and get it fully leased out, and generating those lease income, and changing the mix that we are currently seeing on the income statement, where interest expense is overcoming the combination of interest income and lease income. Of course, during the 6-month period, we would have exited 388.68 million. So we continue to harvest, and this harvesting would have primarily represented the Spanish Penwood transaction, which, as perhaps we learn about a little bit later, maybe I should mention it here. We have a remaining portion of Spanish Penwood, which more than likely, what we'll do is keep that portion of that asset rather than disposing of it, which should actually be down to the benefit of shareholders and SRF, because the value of that asset is likely to grow over time. I would have grown, and it obviously also is a lease income asset, which is already being reflected on the balance sheet. So I'm just trying to present the fact that as we optimize the balance, the asset mix, and and monetize some of the assets on the balance sheet by getting cash back from our investments, doing exit, etc. Then as we go through time, the balance sheet is going to look a little bit different, and the inflows and the cash flows will look a little bit different as we head into the second investment life cycle. Next. So in terms of investment allocation, I won't spend much time here. Nothing has really changed. I guess the big thing here, you can see what I was saying about optimizing strategic asset mix. Investment property is more than 3/4 of the balance sheet, right? And what I've been saying is that this is going to be, obviously, it's going to be reduced as we ramp up investments in REINs. Joint ventures are going to fluctuate, but then we should have a better mix of assets on the balance sheet. Next. So now we're into summary of key strategic assets, and I won't spend too much time here. Nothing has changed. All of these assets have been on the balance sheet for some time, but you can see that based on our portfolio mix, we are primarily in commercial and industrial, right? The largest assets are actually commercial, industrial, and of course we have that large hospitality asset. But as we go through time and we start to monetize some of those assets on the balance sheet, the mix is going to change somewhat. And perhaps what we're going to see here is that we're going to have some more assets that's representing, for example, lease income as we exit one Belmont and hold that on the balance sheet as a lease income asset. So I will now turn to David to provide some more information on some of these key strategic assets in terms of what are the new developments with them since we would have presented at the last earnings call.
Thanks, Jason, and good morning, everyone. The first project that I will give an update on is Spanish Penwood, which, as you would have heard Jason just outlined, the project is complete. The tenant has moved in and is fully operational at a location. Those of you who have the opportunity to drive past, it's right at the intersection of Spanish Town Road, Penwood Road, and Chesterfield. See your asset at work. The exit, of course, as pointed out by Jason, is partial, and you heard, of course, that he is taking steps to evaluate ways in which he can potentially increase your shareholder value here. But essentially, this project is 100% complete. Next project, please, is 1 Belmont. Again, this project is currently at 90%. For those of you who may have driven past in the last few days, you would have seen that the actual 1 Belmont sign has now been mounted on the front of the building, and the tenants are now in the midst of their interior build-out space process. The planning for the exit of this particular project has commenced, and of course, in due course, Jason and his team will update you as to how they will structure the investment vehicles for this particular exit here. But the main thing is that as you drive past it, you can see that the project itself is pretty much just a couple of percentage points off 100% completion. Next project, please. This is Miami Bay, one of the strategic investment properties Jason spoke about in Miami Bay in St. Anne, sandwiched between Old Fort Bay and Sandals Duns River. As you can see here, we are still making good progress towards a decision phase, and we're currently still in the midst of ongoing discussions with various partners. And of course, in due course, we will come back to you to update you on any decisions that we'll make for this particular property in due course. The next project, please, is Lakes Pen. You can see here now we switch to industrial. This is our 55-acre industrial property out in St. Catherine on the Lakes Pen Road. You can see there on the diagram on the right-hand side, for those who can see a screen, diagonal opposite where the Recinco plant is located. And we have made significant progress with this particular asset. And as you can see there, we are expecting to commence the construction targeted for later on this particular year, as in 2024. But we are very, very advanced in terms of our planning and preparations for this asset here to be monetized. Next is the Hillcrest. This is the former French embassy on Hillcrest Avenue. Currently tenanted, as you can see there on screen, and we are continuing to evaluate all the various options that we have before us. But what we can say, as you can see on screen, is that we expect monetization of this particular asset here at some point during fiscal year 2024. Next slide is our dual properties sitting adjacent to each other on Lady Musgrave Road. Excellent location, 56 and 58. As you can see there, lot 58 is actually currently tenanted. And the fact that these two combined gives us 1.2 acres in a very good location. We're just sort of in the midst of finalizing our value enhancement options or evaluation of the options before us. And just like Hillcrest, we expect that the fund manager will be able to monetize this property here at some point before the end of fiscal year 2024. Next is 26 Seaview, right at the corner there. Those two roads you see there on the right is Seaview Avenue. On the left, at the bottom of the screen, that is actually Montrose. So it's the intersection of Montrose, Lady Musgrave, and Seaview. Again, this is another property that, like the two prior, we are in the midst of completing our options or evaluation of the options to enhance the value here. And we also expect that we will be able to monetize this particular property at some point here during the fiscal year 2024. So quite advanced in terms of evaluating of the options, and you will hear more from the fund manager in due course. And then, of course, 16 Montrose. This is a 1 acre property on Montrose Road. The this another property. It's a residential area, as you can see on the screen, and we are continuing to look at the options before us to actually enhance value here. Not as advanced as the others, so we won't say here exactly when we'll monetize this particular property, but rest assured we are continuing to evaluate all of the various options currently before us. And with that, I will say thank you and hand back to Jason.
Thanks, David. So to close out, we're just gonna go through this last slide, which is focused on what are we doing, given the fact that we're in kind of a down phase, right? We're not really deploying capital as we speak. We are just executing on some of our remaining projects to exit, and then going through the process on the two strategic assets primarily, and of course assessing some. So there are the three main tools, three main legs to the strategic initiatives tools. The first one is execute our key strategic initiative, right? And that spans a number of items. Basically, we need to get one Belmont done over the remainder of the financial year, and then to exit, which we went through already, and that is going beautifully. And again, congrats to all the persons who are working on this tirelessly. Dr. Ike Johnson, David who just spoke, and the real estate team, all of the engineers, QSs, contractors, etc., 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 etc. It's a phenomenal product that should generate a very nice return for shareholders. Of course, the second thing that we have to ensure we do is don't wait until we are finished with the first life cycle, but start the second life cycle, so there's an overlap. And of course, Mammy Bay and Lakesland are those two primary projects. We're also, seeking to, which we are already assessing, deepen access to flexible capital in the real estate industry by executing on joint ventures, and we have a number of joint venture partnerships that we are reviewing, that we want to bring on the balance sheet before the end of this year, which is in keeping with starting your second investment life cycle before you finish the first, so that by the time you finish the first, you're up and running, you're not waiting around. We're also looking at some co-developments, and of course, we're evaluating a number of third-party real estate investment notes, REITs, which, at various stages of approval. So we are doing work. It's just that a lot of capital hasn't really gone out the door over the last quarter, and in the quarter that we are in, not a lot will go out the door either. And because of the phase that we are in, we are doing assessments, etc. But by the time we get to Q4, that's when we would expect to start making some moves. Portfolio realignment, spoke about that, which is optimize and monetize the assets on the balance sheet. I spoke about the fact that we will now move into a phase where we'll have assets with substantially more lease income than before. Also speaks about their assets that may move off the balance sheet as they are monetized, that will generate lease income, and we bring on more REITs that will generate more interest income, so that we can get coverage for upward, and of course reduce some debt, or change up the mix of debt, so that we can cover the income, cover the interest expense. So I spoke about the investment lifecycle overlap, so I won't go through that again. So the second leg of the strategic initiatives tool is basically to ensure that we now have enough dry powder. So we started the work on the second investment lifecycle already, so now we need to ensure that we have enough dry powder to fund it through the life cycle. So the first thing that we have to do, obviously, is to harvest our current investment and then redeploy the capital, which we have gone through a number of phases of that already. We have already harvested some assets. We have assets to harvest. And so we are seeking to continue to do that, get to the end of that, and then recycle some of that capital. Of course, we'll pay dividends out of some of that capital that we are as well. Second thing is ensure that we raise appropriately capital for specific projects that we are deploying. So we do that in two ways. One of them is to do a general secure debt raise, which we would have launched, I think, over the past week or so, to raise up to 1.9 billion Jamaican dollars and 10 million US dollars in a multi-tranche secured debt capital raise. And this is effectively to fund those strategic projects that we spoke about earlier, and as well as greens. And then where required, where we have specific projects such as it might be some of those new JVs that are coming on stream. It might be for any one of those two strategic projects, then we will seek to raise quasi-debt or equity capital at those specific subsidiary level to ensure that those projects are executed. And this will involve, of course, sometimes bank financing or pref share or direct equity capital at the individual project level. Third and final thing, which I know myself included as a shareholder, everybody's looking for that first day, is when we make the first distribution. And I know that AGM, I would have said that, I'm very passionate about this, but I'm not going to commit myself to another date at the risk of having to eat my words. But safe to say that we are well down the wicket in ensuring that we make that first distribution in as short a time frame as possible, because we have a very short window left to exit what I would call is our major or biggest development to date. So without further ado, I will end there and I'll take all the questions that you may have.
Thank you, Jason and David, for the remarks. And as Jason would have said, we're going to just jump right into the questions. So I'm going to start off with a very simple question, but it's very important for the discussions that we're going to be having. What is a REIN?
Oh, good question. So a REIN, by the definition of a REIN is real estate investment note, right? But what it is, it's basically a customized debt instrument that we use to invest in, let's say, for example, a residential project. So let's say John Brown wants to do 20 luxury townhouse units, and when they, based on the location and the area where they have those 20 luxury townhouse units being done, demand is very high, right? And therefore there isn't a great challenge in selling off those units. So what we would do is assess the development and say, okay, we're going to fund this transaction, and we will come in, for example, and we can do it many ways. So the developer may need $100 to fund the development, and they have $20 worth of equity. And let's say, we look at the unit, the development, and we think that it's a good transaction, then we will come in and we could fund the $80, and we will say, okay, I want a coupon. I want that you need to pay me, let's say, 14%, coupon. So it's a debt instrument. So I get a 14% coupon, just like a normal bond. But I also want, let's say, 10% of the profits. For obvious reason, because the project may really need, let's say, 30% equity and 70% debt. So we are basically putting in part of, we are taking a little bit of equity risk. That's one way to fund it. Another way would be Mary Jane might have a commercial complex, and she wants to build out some kind of small office building, and it's gonna be leased to some medical doctors or whomever, and we could come in and just simply fund at, let's say, I'm just throwing rates out there, right? 14.5% coupon rate for 3 years, and the underlying building, of course, would be our collateral, just like in a residential development, the underlying building would be our collateral. So basically, it's just investing in a real estate project that somebody else is doing, and we fund it with a debt type structure where we either get pure coupon cash, or we get a mixture of coupon but a little bit of upside in equity, capital gains. That's what our real estate is designed to do.
Thank you, Jason. Okay, so the next question is in relation to Spanish Penwood. When did the lease begin, or when was it executed?
So I think the lease began sometime back in June, July, and yeah, so that's when it began. So the question is, when did it begin, or when was it executed? Yeah, so the payments began back in June, July, but it would have been executed long before that. This was a built to suit facility, and so we basically, with our partner, would have negotiated where we went and bought the land and conceptualized the build out for them, structure the financing of the build out in a very innovative way, and then negotiated a long-term lease contract in US dollars, and then handed over the building to them. They started paying lease, and then the investors who we would have brought into the transaction would have funded half of their money more than a year ago, and then they funded the remaining half. Well, two of the investors funded their remaining half in September, and so we have basically a third of the asset left, which we think that we may get more value from keeping on our balance sheet and keeping the lease income and benefiting from the capital appreciation, which we would not benefit from if it was actually sold. So we may have obviously decided to sell it at a later stage, maybe a couple of years from now, when the value would have increased, because the value of the asset is increasing each year. So that would be a good thing.
Thank you, Jason. So the next question is in relation to capital redeployment. What type of assets are being considered for the capital redeployment exercise?
Oh, so all assets. So right across the spectrum, right? Obviously, we have a hospitality asset at Miami Bay that we are doing work, started and done a lot of work on, and we are getting closer and closer to the time when we will, I guess, start the monetization process. We have Lake Pen, which we have started, getting our approvals, etc., and we have construction to begin on that later this year. So obviously, capital is gonna go there. We're looking at a couple of joint venture transactions. Obviously, One Belmont was the largest joint venture. It's a substantial project. So we need to replace that joint venture with other joint ventures, right? We're looking at joint ventures that are in the neighborhood of what One Belmont was, and some other joint ventures that are smaller. But we're looking at JVs with various partners. So obviously capital will get redeployed there. We're looking at real estate investment notes, particularly to fund residential projects, but also commercial projects, right? So it's right across the spectrum. Industrial assets, as we would have explained, hospitality assets, commercial assets to replace what is a beautiful project and of One Belmont, and obviously real estate derrings, which are our bread and butter income earning generating assets.
Thanks, Jason. The next question is in relation to the capital raising initiative. When did the 2 private placement raises begin? What is the tenure and rate for the USD and JMD raises or challenges?
If I remember what those are, so I think this would have gotten approval. I think these were launched 2 weeks ago. I think on the data last I had it's 11.5%. The USD side, I don't recall exactly what it is. Maybe, but I'll just pull up my file and then give you that answer before the call ends. I don't have that on hand.
All right, thanks, Jason. So we'll move to the next question in the interim. So the lease income line has been increasing. Is SRF shifting from development to lease income?
No, so I would have explained this at length earlier, so let me explain it again. We're not shifting, right? What we are saying is that we conceptualized these developments and we got them leased, right? So we are intimately familiar with the tenants who are in the buildings, because we are the ones who went and originated the tenants in the first place, right? So we know the tenants extremely well. So what we are saying is, rather than selling off all 100% of the assets, it makes sense for us to keep a portion of those assets on our balance sheet for 2 reasons. One, we get income that we can use to smooth out, because as you can see, our interim financial statements, it's very lumpy. So you have to wait until year end to really get the true picture of what SRF is doing, because when you look at interim financial statements, you don't see negative numbers, and nobody likes to see negative numbers. So I'm saying that one way to kind of mitigate against that going forward is, okay, let us keep back some of those lease assets that we were the party that actually created these, right? And by so doing, we have a very confident, we are very confident in the tenure of the lease income remaining with us for a very long time, because we are the ones who negotiated the leases, etc., etc. As well, so that's the first benefit. The second benefit is that because these are lease assets, and obviously you know how lease works, the income goes up at least, well, maybe annually or every 2 years or whatever the frequency may be, which means that the value of those assets will increase. So when I'm exiting an asset, I don't really need to exit 100% of the asset. I can exit part of the asset and keep a part, and then effectively what will happen is that the value of that asset is going up, and when I want to sell it, and I'm sure that I can sell the asset and get the value that I'm carrying on my balance sheet, because it's already tenanted, right? It's already performing. It's already generating substantial cash flow. And so when I do that, obviously there are additional capital gains to be had. So if I hold on to it for an extra, say 2 years, then obviously what happens there, I generate more gain than when I sell it after it has been completed. So for those reasons, we're not changing, we are basically optimizing the business model as we go through time, and we see the idea that we had on paper, and we start to understand more how the business is evolving, then we evolve along with the business, right? So we are saying basically, if we can generate more returns by holding onto some assets that we develop and generating lease income by getting a higher gain when we are selling, because the appreciation of the asset and the performance of those assets, given the type of, when we started conceptualize SRF, we had an idea that we're gonna basically develop buildings and put tenants in them and then sell them, right? But the quality of the tenants that we are getting in these buildings is beyond our expectation. So while we thought that we could get tenants in the building, we weren't thinking that we would be getting the quality tenants that we have. So it only makes sense for us to say, okay, let's, all of these things, maybe we need to keep a portion of all of these and hold that for lease income so that we smooth out that lumpiness, to help smooth out that lumpiness that you're seeing in the interim financial statements. And at the same time, you have a cake and eat it, because you get very good income, and the value of the asset that generated the income is increasing, because the income itself is increasing annually, because lease rates increase annually. So I mean, it's to us it's a no-brainer to make that adjustment.
Thank you, Jason. The next question is in relation to a comment that was made in the presentation. You mentioned portfolio optimization earlier and noted certain assets. Is it that these considered exits, for example, Hillcrest, would be through strategic investment vehicles or secured debt financing?
I don't want to say any more than, you know, at the end of the day, we invest money, and we need to generate a return and get back cash, right? That's why we do investment. That's why shareholders give us money to invest. So that's what we are doing. So whatever is the best means to do that is what I mean when I say optimize. So it's any and all of the above plus other things. There's no one specific thing that is involved. So you know, we are simply optimizing and to ensure that we deploy capital, we get back capital, and you know, we right size the portfolio to ensure that the heavy weighting that we have currently, we create more balance, and so that as well, you know, we can start the process of providing cash back to shareholders in a consistent fashion, and also have a financials that when you take up the interim report, you know, you don't have to be wondering if these guys are going to be able to ever produce a report that doesn't have a negative interim financial, despite the nuances around our investment model, where we basically deploy capital in the projects first, and then that capital is seasoned in the project, and then it's at the back end. When you exit, you get by your cash. So all we're doing is just simply streamlining the portfolio so that it works for shareholders a little bit better than in terms of providing back cash to shareholders, because the return on average equity has been great. So what we are trying to do now is to provide back some of that cash, some of that return in cash to you as shareholders, having deployed out a lot of money over the past 4 years.
Thanks, Jason. The next question is in relation to an asset held for sale on the balance sheet. There was a 1.11 billion asset held for sale up to February 29. Did that represent the 33% unsold Spanish Penwood property? And with the plans to retain the interest, will that return to investment property?
Good question. So that value represented the entirety of the Spanish Penwood asset. What will happen, given the decision that we are likely to take, is that if we end up retaining that, which is more than likely retaining a portion, then what will happen is that that value of that asset will be removed from the balance sheet, and it will be replaced by the portion that we maintain, and that portion that we maintain obviously will continue to generate income. We have already gotten the capital we have already been paid the capital from the other two investors for the 67% that was exited. So there's no more cash coming from that percent, just from the lease income.
Thanks, Jason. All right, so we have a few more questions. I know we had started about 5 minutes late, so I think we can take 2 more and then we can wrap up. Please elaborate on the plans to correct the negative net interest income for SRF.
So I just did that. So let me do it again. So basically, we are increasing our investment in REINs. I think combined REINs and assets that generate lease are expected to perhaps be more than at least 30% of the total portfolio value over the very near term. So as I said before, we have 1.8 billion right now in REINs. That is likely to perhaps almost triple as we enter investment life cycle 2, or investment life cycle 2. In terms of lease income assets, the assets that we have on the balance sheet right now, the lease income. So I mean, if you look at Hillcrest, it's generating lease income, but it's not really lease income, because it's not like intentional lease income. It's really like a short-term facilitation in terms of that lease income. 58, that is generating lease income. Again, that's not, it's lease income, but it's not really lease income. In other words, we kind of inherited the property with lease income on it, right? So it's not like we created something to generate lease income. So those lease income aren't really substantial. Now, the Spanish Penwood lease income, that's real lease income, because we design and conceptualize, and so that portion that we're holding back, that's a decent amount of lease income that we're generating at market rates, because the other two that I spoke about aren't really market, quote unquote, market rate type lease income. One Belmont, when we exit that, monetize that, and then we keep back a portion of it, that's gonna generate market rate lease income, which will be substantial, right? Based on the portion that we are thinking of keeping. So what I'm saying to you is that if you look at lease income divided by the asset that's generating lease income, so maybe if you lose income to assets ratio, which is take lease income and take real estate investment notes, and the income generated from those divided by the total value of lease income assets and real assets, that ratio should be substantially higher than what it is now, primarily because on the lease side we have large assets generating very small lease, because those leases are really just temporary leases or short-term leases. They are not really strategic market rate lease. So the combination of those two things should, as well as obviously, when we get back, being very strategic about how we utilize debt. So obviously we have some debt on the balance sheet which are being paid down, reduced. And when we, for example, exit certain assets, the debt that is financing that asset will go away, and then replace that with debt that is actually generating income. So for example, some of the capital that we are raising is gonna going to fund assets that are generating income. So the combination of those two things in terms of substantially increasing the value of investment in REINs, monetizing some of the investment property that we have, and redeploying that into REINs, obviously, and of course bringing One Belmont from a joint venture into an asset that is generating income. The combination of all of those things will substantially improve our total investment income, which is effectively what is driving the negative net investment income, and hence the negative earnings during the interim period. So those are things that we're seeking to change. Obviously, over the short to medium term as we ramp up investments into new joint ventures. Those are going to give you some gains as well during interim periods, but the focus is to have the cash generating assets basically ensure that net cash earnings is positive in interim financials.
Thanks, Jason. So we'll just take one last question. You mentioned that the holding of projects or the retaining of assets in consideration of lease payments is aimed at smoothing out the flows. But what are your projections and time horizons given the massive capital outlays for projects, and how sustainable is it?
Well, I mean, good question. So, but the question also answer the question itself, right? Because basically, the capital outlay for project is normally very large. And so the idea is, if you look at the balance, if I had 80% of my capital going into projects where I'm waiting to get back the value at the end, and I change up that mix and I say, okay, I'm gonna do joint ventures instead. I focus a lot on joint ventures versus project that's on my balance sheet. Then what that does, what you're seeing on my balance sheet is that the capital that's going out, that's not being reflected on my balance sheet, and therefore flowing through my income statement, right? And if I also decide that I want to deploy a lot more capital into REINs, as I deploy capital into REINs, I'm earning while I deploy. So I'm not waiting until the back end. So in other words, outside of the two strategic assets that we have on the balance sheet, which are Miami Bay and Lake Spen, which those projects are not in their final stages in terms of execution, right? Because once they get to the final stages of execution, the way the projects are being financed is going to change because external capital will more than likely be coming in. So what that will mean is that I'm no longer kind of deploying a ton of capital and primarily depending upon exit value at the end to see results on my financial statements, because I've kind of rebalanced from being like almost 80% doing that to more of like a 50, 60, 40 kind of situation, which then enhances our ability to cover expenses, which is effectively what results in negative earnings on an interim quarterly basis.
Thank you, Jason. So that brings us to the end of the question and answer segment. I want to thank everyone for joining our earnings call today. We do appreciate your time as well as your participation. If you have any questions that weren't addressed or weren't addressed fully today during the call, please feel free to send them via email, and the email is on screen, srf@sygnusgroup.com. We are looking forward to the session or the discussion that we'll have for the next quarter. And we want to thank you again. Have a great day.